We're jumping straight into Cameco today. Everyone is watching the volatile price action and that dramatic upswing in uranium prices. But the real story here, I think, isn't just about, digging rocks out of the ground anymore. It's about this massive fundamental transformation.
Right.
We're seeing Cameco shift from being, well, basically a pure uranium miner.
The commodity play.
Exactly, a commodity play, to becoming this core, vertically integrated nuclear energy infrastructure platform. It's a huge shift.
A huge shift, and it's being driven by these, enormous macro forces. You've got the global nuclear renaissance, sure, but the big one now is the power demand from data centers.
It's AI.
AI, exactly. And then you layer in that strategic partnership with Brookfield and the U.S. government, which, just solidifies their position across the entire nuclear fuel cycle.
That transformation is absolutely the key. It's what sets them apart.
It is. You're with us on the Easy Money Show, where we make sense of these big market moves, and understanding that move from commodity to infrastructure as well, it's everything right now.
And before we get into the weeds, if you're enjoying the analysis, make sure to subscribe and hit that like button. It really helps the channel. And definitely let us know in the comments which stock you want us to simplify next.
All right, let's unpack that transformation. When we look at Cameco, we really need to focus on why utilities and governments are leaning on them so heavily, and, why the market seems willing to pay such a high premium for the stock. It all comes down to their strategic moat.
Okay, so let's break that moat down. What makes Cameco different from, any other company that just operates a uranium mine? This is more than just having cheap ore.
Yeah, way more. What's fascinating here is what you could call the triple advantage. It's scarcity, scale, and integration. On scarcity and scale, look, Cameco is a top 2 global producer. They control some of the highest grade uranium assets in the world, and they're mostly in Canada.
Which is huge. A stable jurisdiction.
It minimizes the supply chain shocks you see everywhere else, but the integration, that's the real game changer. And that's the Brookfield and Westinghouse deal.
That 49% stake.
That 49% stake in Westinghouse Electric, it just fundamentally transforms their whole business model. It gives them exposure to the entire nuclear fuel cycle, not just the front end.
Okay, so help us understand that fuel cycle a bit better. Mining is step one, we get that. But what happens next? And why is owning that downstream part so valuable?
Think of it like a super complex, highly regulated assembly line for energy. First, you have the mining, the raw uranium ore. Then it goes to conversion.
Conversion.
That's where the ore gets turned into a gas, uranium hexafluoride, which is what you need for the next step, enrichment. After enrichment, you get to fabrication.
And fabrication is making the actual fuel rods.
The fuel assemblies, exactly. The physical bundles that go right into the reactor core.
So owning Westinghouse means they can control and profit from all those later stages, conversion, fabrication, even the nuclear services.
High margin, highly specialized stages. They aren't just selling the raw ingredient anymore. They're selling the entire highly regulated service pipeline that you need to power a reactor.
And that's a whole different ballgame.
It is, because in the nuclear world, security of supply trumps cost. Almost every single time. Utilities have contracts that last for decades. The switching costs are massive, so Cameco's long-term contract book, that's what provides the stability. They're selling reliable performance, not just, a commodity price on a screen.
And that stability, that's why governments are getting involved. That partnership with Brookfield and the U.S. government, it entrenches their position as a critical Western supplier, right?
It absolutely does. The U.S. nuclear sector is gearing up for a huge build-out, something like $80 billion plus.
Wow.
Driven by modernizing old plants, life extensions, and of course, the big one, small modular reactors, SMRs. By partnering with the U.S. government, Cameco is basically baked into that long-term strategic policy. They become the preferred provider.
Okay, so let's connect that back to what you said at the start about AI. Why does the AI boom specifically benefit a company like Cameco? Why isn't solar or wind enough?
It's all about baseload power. AI training, data centers, they are incredibly energy intensive and they need power 24/7, stable power.
You can't have your servers go down when the sun sets.
You can't. Nuclear provides that high capacity, reliable baseload power. So as big tech plans these massive new data centers, they're specifically looking for clean, scalable, reliable power. Cameco and Westinghouse are now positioned as key enablers for that.
That makes the strategic argument crystal clear. But let's pivot from strategy to the financials. The numbers have to back this story up.
And they do. The numbers really confirm the story, and they show this tremendous financial resilience and operating leverage.
We saw that strong top-line growth, In 2024, revenue surged, what, 21.2% year over year,
Yeah.
up to see $3.14 billion. That's solid execution. But the more compelling story, and I think this came out of the Q3 2025 results, is this earnings catch-up idea.
That is the crucial piece the market is pricing in right now. See, historically, because the contracts are so long-term, Cameco was delivering material at much lower legacy prices, even while the spot price for uranium was soaring.
All right, so there was a lag.
A huge lag between revenue and profit. The Q3 2025 results show that inflection point has finally arrived.
What does that mean, the inflection point?
If you look at the first 9 months of 2025, their adjusted EBITDA was significantly higher than 2024. That signals the operating leverage is finally kicking in.
So those new higher-priced contracts are starting to roll into the mix.
They're rolling in, and the earnings are finally catching up to the realized prices. That means margin expansion we haven't seen in years. That's what justifies the bullish view.
Okay, so the rising uranium prices are now actually flowing through to the bottom line. And what about the balance sheet? It has to be strong to fund all this growth.
Rock solid. They reported, what, $779 million in cash at the end of Q3 2025, plus a $1 billion undrawn credit facility, and crucially, a very low debt-to-equity ratio of 0.15.
And why is that 0.15 number so important for someone listening?
That ratio is a massive safety net. It's also a funding mechanism. It means the company isn't heavily reliant on debt. They have ample capacity for huge projects like expansion or M&A without having to issue new shares and dilute everybody.
Makes sense.
When you're talking about a multi-decade build-out of nuclear infrastructure, having deep pockets really matters.
And it seems like investor confidence reflects this. They doubled the dividend recently to $0.24 per share, and institutional ownership is over 70%.
Exactly. When you see sophisticated long-term investors, we're talking sovereign wealth funds like Temasek, big pension funds, actively buying more, even after the stock has run up, it tells you something.
Yeah.
It confirms they see this not as a temporary commodity spike, but as a foundational infrastructure asset. They're buying the long-term energy transition story.
Okay, switching gears a bit. Let's look at the technicals. The fundamentals sound great, but what's the chart telling us? How is the market digesting all this news?
Technically, the stock is in a sustained long-term uptrend. No question. It's sitting comfortably above its 200-day moving average, which is acting as strong support, somewhere in that $66 to $70 range.
So the primary trend is still firmly up.
Firmly bullish.
But it has been a little choppy lately. It feels like it's been taking a breather after that explosive run.
That's a perfect way to put it. The current structure is what analysts call intermediate consolidation. The price is just kind of oscillating around the 50-day moving average. And this is totally normal behavior in a strong bull market. The stock digests its gains, it brings in new buyers, and it prepares for the next leg higher.
A necessary cooling off period. And are the momentum indicators, like RSI, supporting that idea of a new accumulation phase?
They are. The RSI is generally neutral right now, and that's important because it suggests the stock isn't overbought. There's plenty of room for new institutional money to come in without it immediately overheating.
Okay, so that's a powerful bull case. Strategic transformation, strong financials, constructive technicals. But we have to look at the other side. Let's tackle the bear case. Valuation has to be number one, right?
Always the number one concern. No doubt. The stock trades at a premium valuation with a high forward PE ratio. And, the recent choppiness and some quarterly earnings volatility, that adds to the skepticism.
It makes people ask, is this thing already priced for perfection?
That's the question. And the second big risk is just production volatility. It's mining at the end of the day.
Right, that's always a risk.
Always. There's the risk of unexpected delays, operational issues like we saw with the Q3 2025 production cutbacks. And historically, the company has had to buy material on the open market to fulfill contracts.
I remember that, up to 3 million pounds previously.
Right. And if spot prices are super high when you have to do that, it can temporarily squeeze your margins.
So how does the bull thesis counter those two big risks? Let's start with the valuation.
The argument is that the premium is justified. It's justified by the scarcity of these Tier 1 assets, the vertical integration, and all the optionality that comes with Westinghouse. The key here is future earnings growth. The idea isn't that the stock price has to fall to normalize the PE ratio. It's that the high multiple will compress naturally through accelerated earnings growth as those big contracts and the Westinghouse income really start to scale up.
So they're growing into the valuation.
Exactly. And the 2025 earnings figures we've seen so far, They already support that idea. The inflection point is here.
Okay, and what about managing that production volatility risk?
Management has shown really strong risk management here. For 2025, they've cut their expected market purchases way down, from a possible 3 million pounds to just 1 million. And they're doing it by using something called product loan facilities.
A product loan facility, what is that exactly?
It's basically a credit line, but instead of borrowing cash, they borrow the physical commodity uranium from a counterparty.
Interesting.
They use that borrowed uranium to meet their current deliveries, and then they pay it back later when their own mining production is back up. It's a way to keep their promises without having to buy at volatile spot prices or burn through cash.
That's a really smart, capital-efficient way to bridge those temporary gaps.
It is. And on top of that, despite the production adjustments, they actually reaffirmed and even slightly tightened their full-year delivery guidance to between 32 and 34 million pounds.
So that shows real confidence in their execution.
It shows clear visibility, even when mine output has a temporary dip. Their strong balance sheet gives them the runway to use these sophisticated tools.
All right, let's look ahead. What are the big catalysts investors need to be watching in the next few months?
The calendar's pretty packed. It's all about earnings and watching what the big institutions are doing.
The main event has to be the Q4 2025 earnings release, which we should see in early February 2026. That report will be critical for updates on realized prices, what they're actually getting per pound, and it'll give us the first really clear picture of the earnings contribution from Westinghouse.
And beyond the company's own reports, we have to watch the institutional flows. In January 2026, we get the 13F filings.
Right, we get to see who's been buying.
Those filings will reveal if the big funds kept accumulating during this consolidation period, or if anyone's been selling. Any big move there will really influence sentiment.
And finally, there's always the speculation around policy and new contracts. That's a huge psychological driver for the stock.
Yeah, you hear constant chatter about new U.S. government contracts or maybe another joint venture with Brookfield. But the biggest long-term thing to watch is any news about new reactor tech, especially SMRs.
Where Westinghouse is a major player.
A major player. Any positive movement there could be a huge re-rating event for Cameco, forcing the market to value them not just as a miner, but as the critical infrastructure partner they are really becoming.
That's the breakdown on Cameco for today. As we wrap up, here's a final thought to consider. Cameco's story, it isn't just about riding the uranium commodity cycle anymore. It's fundamentally about providing critical, geopolitically secure infrastructure for the world's accelerating demand for stable, low-carbon power.
And that demand is being fueled not just by climate goals, but specifically by the massive, unrelenting power needs of data centers and artificial intelligence, which simply cannot tolerate intermittent energy. So ask yourself this: how much value does the market truly place on reliable, strategic infrastructure assets in a fragmented and energy-hungry world, especially when that infrastructure is essential for the future of technology? If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.